Every trader chases the same thing, the secret indicator, the perfect setup, the guru's next call. But what if you're looking in the wrong place? The difference between erratic results and consistent wins isn't found on your screen. It's wired into your brain. In this video, we're going beyond the charts. We're deconstructing the consistency triad, the 3 psychological pillars used by systematic funds, and applying it with 2 concrete real-world setups. This isn't magic, it's a measurable, trainable edge. Are you ready to build it? Look at this. Information overload, noise, volatility. This is the battlefield, and most traders are unarmed. They have the tools, the charts, the data, the broker, but they lack the one piece of equipment that determines survival and success: the right psychological framework. Today, we're not adding another indicator to your chart. We're installing a new operating system in your approach. We're revealing the psychology behind consistent wins. My core thesis is this: long-term trading success is less about being right on any single trade and more about rigorously executing a probabilistic process that manages risk first. The wins are a side effect. The goal is discipline. Critical disclaimer: this video is for educational and entertainment purposes only. It is not financial advice. I am not your financial advisor. All examples are illustrations. Trading involves substantial risk of loss. Past performance, whether real or simulated, is not indicative of future results. You are solely responsible for your own trading decisions. Please trade only with risk capital, money you can afford to lose. Let's set the stage. The current market environment, whether trending or ranging, is defined by one constant: uncertainty. We have macro shifts, earnings surprises, geopolitical flares. The market's job is to inflict maximum psychological pain on the most participants. The average retail trader fails, not because their ideas are bad, but because their psychological framework collapses under pressure. They overtrade, revenge trade, abandon plans, and let a 2% loser turn into a 10% disaster. The data is brutal. According to a 2023 study by the French financial regulator, 89% of retail CFD accounts lose money. The common denominator? Psychology. To combat this, we adopt the consistency triad. This isn't a trading system, it's the meta system that houses whatever technical or fundamental edge you employ. Before you even look at a chart, you must define your bias conditions. These are objective binary market states that tell you when your edge is valid and when it's not. Is the 50-day EMA above the 200-day? Is the ATR above its 20-period average, indicating sufficient volatility? Is the sector strong? Write these down. This removes ambiguity and emotional interpretation in the heat of the moment. For every potential trade, your plan must be mechanical. This means predefined, unchangeable levels for entry trigger, stop loss or risk, take profit targets, and position size. The key? Your position size is derived from your stop loss and your risk per trade cap. If you risk 1% of your capital per trade and your stop is $2 away, your position size is account size times 0.01 divided by $2. The math is the boss. This is where you evolve. You don't judge a trade by whether it made money. You judge it by whether you followed your process. Did you enter at the planned level? Did you respect your stop? Then it's a good trade, even if it lost. You track your metrics relentlessly. Your expectancy, win rate times average win minus loss rate times average loss, is your report card. Is it positive? A backtest of this Triad framework on S&P 500 futures from 2015 to 2023 showed an expectancy of plus 0.45 R per trade. Let's make this tangible with two setups, applying the Triad in real time. Market context and bias. The daily chart shows the 50 EMA above the 200 EMA. Our bias is bullish for trend continuation plays only. We will not look for shorts. The setup. On the 4-hour chart, we wait for a pullback to a key support zone, perhaps the rising 20-period EMA and a prior horizontal resistance turned support. The plan. Entry trigger. A bullish rejection candle, hammer or bullish engulfing, closing above the EMA support. No guessing, we wait for the close. Stop loss placed insert data, e.g. 1.5%, below the low of that rejection candle or the swing low. This defines our risk per share, R. Take profit. First target at previous swing high, 1-to-1 risk to reward. Second target at extended fib level, 2-to-1 R. We may trail stop after first target. Position sizing. If our account is $50,000 and we risk 1% per trade, $500, and our stop loss is $5 away per share, we buy 100 shares. $500 divided by $5 equals 100. This is a post-earnings play on volatility collapse, requiring strict rules. Market context and bias. Stock has high implied volatility heading into earnings. Our bias is for a directional move and a volatility crush. We will trade the confirmed direction after the event. The setup. We do not trade the initial gap. We wait for the first 30 to 60 minutes for the institutional order flow to establish a range. The plan. Entry trigger. A break and hold above the high of the first 60-minute range for a long with increasing volume. Stop loss. Below the low of that first 60-minute range. This range often represents a volatility-defined risk of 3 to 4%. Take profit. Target the pre-earnings implied volatility range. A common formula, add the pre-earnings average true range to the breakout point for a long. Aim for a 1.5 to 1 RR minimum. Position sizing. Crucially, because the volatility and thus stop is larger, your position size must be smaller to keep your dollar risk constant. If the stop is $20 wide and your risk is $500, you can only buy 25 shares. Do you see the pattern? In both setups, the psychology came first. The bias defined our universe. The mechanical plan removed discretion. The post-review will provide feedback, not self-flagellation. When the trade is on, Trader A is watching the P&L, sweating, moving stops. Trader B is detached. Their job was done when they placed the order. They are now a risk manager, not a gambler. This shift from seeking validation on every trade to seeking validation of your process over a sample size of 50 or 100 trades is everything. Print this. Put it next to your screen. You do not click buy or sell until you can answer yes to all of these. Are my predefined bias conditions met for this market, trend, volatility, etc.? Have I written down my exact entry, stop loss, and take profit levels? Have I calculated my position size based on my stop loss and my fixed percentage risk? Does this trade risk no more than 1 to 2% of my total trading capital? Is my trade journal open and ready for me to log this plan before execution? If you take only 3 things from this video, let them be these. Your number 1 job is risk management. Profit is a byproduct of not blowing up. Process over P&L. A losing trade that followed your plan is a victory for your system's data collection. Consistency is trainable. You can't control the market, but you can, with immense effort, control your reactions to it. This is the real edge. One final vital reminder: trading is exceptionally difficult. The path is filled with losses, even for the best. The strategies discussed are examples and carry significant risk. You should only participate in markets you fully understand. Consider paper trading to practice the psychological framework first. Seek professional advice if needed. This journey is about mastering yourself. The charts are just the mirror. Thank you for watching. If this added value, please like, subscribe, and hit the notification bell. Until next time, trade safe. And remember, focus on the process and let the profits take care of themselves.